Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Facebook. Well, first of all, let me show you. So this is the structure I'm going to use. Past performance is what we're going to see first. I'm going to check the annual reports. I'm going to give you an idea of some of the main points that I see there. So first, our mission is to give people the power to build community and bring the world closer together. So our business is characterized by innovation, rapid change, and disruptive technologies. We compete with companies that sell advertising to businesses looking to reach consumers, for example, Google, Apple, YouTube, Tencent, Snap, Twitter, ByteDance, Microsoft, and Amazon. Our internal operational demands continue to grow. We will need to increase the amount of technical infrastructure, including network capacity and computing power, to satisfy our needs. Facebook does not rent out IT infrastructure like Amazon will do in AWS, for example. And I guess that it has to do with the mission. Their mission is to connect people, and anything that's diverting from that, they don't follow. And they in fact, they could, I think, rent out IT infrastructure and be competitive with that, because they have heaps of data that they have to use and process, and that would, of course, they have systems that could be valuable for third parties, but they are not doing that. They mention laws and regulations. We know that this is an issue for Facebook. Of all the tech companies, Facebook could be the more vulnerable there, I think. You can see here $6.2 per person, and then came to $6.10 per person. Unfavorable publicity, I think, is about, for example, private practices or concerns about political speech and stuff like that is, I think, one of the main risks with Facebook. Another issue is that the chairman and CEO has majority voting power, because there's a double class A and class B. And one other thing is that they are not planning to pay any dividends, which in my case is something I like. These are the measures that we're going to see during our analysis, and all of them have been growing quite substantially. If you see here, the monthly active people got to 3.3 billion in December 31, 2020, a 14% increase. And this, if you compare with the world population without China, because they are not in China, is 52% of the population. 52% of the population uses monthly any of these of the family products. And one thing that I want to point out is that Facebook historically reported the numbers of daily active users, monthly active users, average revenue per user. They call this Facebook metrics because they included only Facebook and Messenger. But since from December 31, 2019, they're going to use, instead of users, people. And that includes Facebook, Instagram, Messenger, and WhatsApp. And they call it the family metrics. Then revenue went up 22%, which is quite substantial. Operations was 32 billion, and the margin 38%, which is also quite good. And if you see, a headcount grew 30%. Okay, and here we see that they are giving us the expectations for 2021 in capital expenditures and total expenses, something I'm going to use in the projections. And they discuss a little bit how COVID has affected the increase in demand for users, but the reduction in demand for advertising. And they are seeing now back to normal conditions. Free cash flow, that for them is one of the key financial indicators. You can see that it has doubled in 4 years at a 20% compounded annual growth rate, which is quite substantial. The CFO in the Q1 2019 call said our capital expenditures are driven primarily by our continued investment in data centers and servers. So this is the main driver of the capital expenditures, and if you see here, it has gone up from 4,000 to 15, so 4 times. And also they show here the summary of the income statement. We can see revenue grew at 33% in these 4 years, compounded annual growth rate. Expenses a little bit, well, these are my projections that I'm going to show you later, are a little bit lower than what they are expecting. Here I want to show you the average revenue per user and average revenue per person, how they have been doing in the last in the few past quarters. You see up 33%, this one, up 17%, this one, and 13% the past year. We can see here that ARPU, or per user, is a little bit higher than per person, because it includes, per person includes WhatsApp and Instagram as well, aside from Facebook and Messenger. But we can see here that the average revenue per user has been increasing, which is not only they are increasing in the number of people, as we saw before, but they are also increasing the ad dollars, let's say, that they can get from each person. And you can see here the advertising is 98% of the revenue of Facebook. And so this is the average revenue per person per year, is $27.51, which is the sum of all this. Okay, and the daily active users and the family, or the daily active people, family and Facebook, respectively, we can see that they have been growing as well. And you can see here that this is growing faster, because I think that Facebook is starting to mature, while Instagram and WhatsApp are starting to pick up. And we can see here the growth of each of these regions. The lowest growth, the most mature one, is US and Canada. Europe also is quite matured. Then Asia Pacific. Asia Pacific is the one growing the fastest, and the rest of the world. Another thing here I want to mention is daily active users versus monthly active users. So 66%, 68%, 66% is quite. This is quite stable. The number of people that uses it on a daily basis is, of course, smaller, 2/3, than the people that uses it on a monthly basis. But if you see here, when we talk about people and we include Instagram and WhatsApp, this is much higher. So there's more engagement in Instagram and WhatsApp on a daily basis versus a monthly basis. And it not only higher than this one, but if you see, it's growing. And this is a good sign. There's more people using it on a daily basis as the time goes by. So this is a graph I made of what we just showed you, but since they started as a public company. And of course the growth, you can see, is going down, but still on the 10-15% range. And we see here the US, Europe, Asia Pacific is the largest now. And well, this is the rest of the world, the blue line. And this is the number of daily active users, 1.8 billion in 2020. The daily and monthly active users now. So here I have the daily active users versus the monthly active users, and another thing that is you can see that it grew at the beginning, and now it's on the 66%. The growth, the monthly active users here, is the 2.7 billion roughly. This is monthly, and the daily is what I showed you before, 1.8. And this line here is the growth, but not on a quarterly basis, but on a yearly basis now. It's tending towards the 10%. Let's see average revenue per user on since 2011. And you see here first quarter, second quarter, third quarter, and fourth quarter of each of these years. You see that the yellow line, the fourth quarter, is normally the highest. So it's a sort of like a cyclical. In the fourth quarter is that they have more revenue, not dramatically higher. The growth again, average revenue per user, is coming down, but quite healthy in the 10% level. And this is the annual average revenue per user, which is also growing. So as I said, they are not only growing in the number of monthly active users, but they are also growing what they can extract per user in terms of revenue. So here we get the revenue. Advertising, as I said, is 99% of sales in 2019, 98% in 2020, and roughly 100% in the years before. It has gone up 42%, the revenue, which quite dramatically on a yearly basis, and last year it went up 21%. And advertising is going to be the predominant revenue source, I think, for the foreseeable future. Even though they have a number of longer-term incentives that they're saying here about artificial intelligence and augmented reality, I'm not sure that that's going to be of. At least I'm not projecting too much there. I'll show you later, and you'll see. They're starting to make WhatsApp more. They're trying to monetize WhatsApp. Instagram they started, and now they want to start with WhatsApp in a way that probably is not going to be via advertising, but via charging some fee to companies to communicate with consumers. They are still working on that, and they are working on what he calls immersive computing platform, trying to connect people more than with screens, with some type of augmented reality like holograms and stuff like that. For them, they say communities are meaningful to them, and this is their next goal. We have updated our mission a few years ago to reflect this, making it give people the power to build community and bring the world closer together. And I think that what I see here is that the customers of Facebook are really the people that sell advertising, not the people that uses Facebook. So I see a little bit of a conflict there, which is, what do you want to make the experience better for advertisers or better for consumers or users? He's talking also about competition from Apple. There's concern in Facebook about Apple operating system 14 may cut advertising revenue to all the applications that go through Apple. One of the goals of Facebook is to give every individual entrepreneur and small business the same kinds of tools that historically only the big companies have had access to. And I think here this is important to consider when I do the projections, and I'm considering this in the growth of the advertising business. I think the advertising business will grow a little bit faster than in the past, because there is more people more small businesses that were not in the advertising business before that much. Probably a little advertising in newspaper here or there, but now they can channel more funds to advertising because they can see quite the results, and they can measure very, very closely the return on that investment. Okay, in the fourth quarter call, I want to point out here that you can see other revenue has grown dramatically this quarter, 156%, even though the amount is not that high compared to overall revenues. But this was due to the holiday sales of Quest, which is one of the Oculus devices of augmented reality. And who knows? Probably this is going to be another line of businesses. And another thing important is income from operations is quite healthy growth, and the operating margin is staying in the 40% level, with some quarters is lower, but it's quite healthy. So this is the operating margin more on a yearly basis since 2011. It's been increasing. As the volume of the business increases, the operating margin tends to increase, and this is something nice to see. Free cash flow has gone up 20% in the past 4 years, and also you can see 4 times it has gone up capital expenditures. So free cash flow on a yearly basis since they went public, you see capital expenditures versus revenue, which is the measure I like to use, the metric I like to use, has gone up lately, and it's in the 20% level. This is quite high compared to other companies and even to other technology companies. But free cash flow is going up very nicely, and the operating cash flow even better, because this is before the capital expenditures that they have to increase every now and then. So this is a 42% growth. This is quite good. So okay, let's now go back to the structure and let's talk about management. Well, first of all, the annual CEO letter of 2012, which is the only letter that he published. So there isn't much that we can learn from the CEO Zuckerberg from his letters, but we have to find that in the quarterly calls or in some interviews that we can find in the internet. It would be nice that he could issue a letter every year with his thoughts and the way he sees the business and challenges, but we can help redefine the relationship we all have with our phones and technology, so it's about people and less about the apps and features. I think this is a little bit of a conflict, because it has to be about apps and features, because otherwise there's no way he can sell that service to an advertiser. What I've heard from him, I think he's a long-term thinker. He has made good acquisitions like Instagram and WhatsApp. Very smart, I think. And so I can say he's a good allocator of capital. I'm not certain that he has quite a simple and very focused view of the company. I think it has a little bit of a conflict of interests in the way he thinks about the company and in the way that the company is structured. So the compensation, which is part of the things I checked in the statement, in the proxy statement, is heavily weighted towards equity, like most companies that are public, and especially if they are technology companies. Compensation, cash compensation, generally below market. CEO has only a $1 per year salary, which is good, but also he has a big percentage of the company, which is also good, because I think that aligns his interests and the interests of shareholders, mostly, not 100%. But then the Compensation and Governance Committee engaged the services of Compensia, which is an advisor for compensation, and this is something I really think is money wasted, because they charge quite large fees to give you formulas like this one, to come with a bonus for one of the executives, and they are quite complicated in a way that I don't think it relies any incentive to anybody, and especially if you see here in the proxy statement, we can see the bonuses. And look at, these are the numbers that go into the formula: 75, 85, 90. It's always in the range of 75 to 100, and it's always in the range of 200 to 400,000 per semester. So I don't think that this is a waste of money and time, I think. Why don't they pay $500,000 more of salary and that's it? I mean, this is not going to incentivize anything. Well, this is the equity compensation, vests quarterly over 4 years. Well, Mark Zuckerberg didn't receive any equity awards, and this is something I'm not that sure it's good. Mark Zuckerberg, I know that they have to pay for security, personal security for his family and himself, $10 million per year. This I think is quite a lot if you compare it with what I'm going to show you in a minute, Amazon, and what they pay for Jeff Bezos. And also he uses the private aircraft and is paid by the company. And in the case of Amazon, for example, the personal private jet is paid by whomever uses it. I mean, Jeff Bezos or whoever. The company doesn't pay a single dollar of private aircraft. But not only for Mark Zuckerberg, but also for the CEO, Sandberg. Ms. Sandberg uses the private aircraft as well. And you see here the compensation, which includes, in all other compensation, it includes safety, security, and aircraft. Here for Sheryl Sandberg and Mark Zuckerberg, you see the numbers here are quite substantial. If you add the total compensation, including salary, bonuses, stock awards, and all other compensation, is $287 million. Of course, this is in a 3-year basis. This is $100 million per year. I want to compare that with Amazon. If you see, Amazon pays $1.6 million of security for Bezos compared to $22 million in 2018, for example, or $9 million or $6 million for Zuckerberg, and for Sandberg, $3 million, $2 million. So even Sandberg is more expensive to Facebook than Bezos is to Amazon. And the compensation, I'm changing this level here because this is not compensation. This is just a revaluation of the stock awards for this person. So this, I'm assuming here only what has been his compensation of that year. And this is the full compensation of 3 years for all these people in Amazon. 20 million per year compared to 100 million for Facebook. In that case, I think they are paying a little bit too much to executives. And here is what I talked about Class B having. Really, as a shareholder of Class A, we don't have any voting, practically speaking, because Zuckerberg gets 57% of the voting of Facebook, so he can do whatever he wants in essence. I mean, I trust that he's doing the right thing, but the fact that he can do whatever he wants is something to worry a little bit. So, okay, this is management. I think past performance ticks the box and management ticks the box. Mainly management ticks the box in my case because I have seen good acquisitions and I have seen long-term orientation in many of the decisions that they have taken. And the fact that I have the CEO still with so much meat, let's say, in the game, I trust that it's going to align my interests as an investor with the interests of this person. So let's go to competitive advantages now. Okay, in competitive advantages, I have identified 4 advantages. The virtuous loop, which is the network effect, probably is the strongest of the 4. And in my case, the companies that have network effect, I think they tend to be monopolies in essence. And for investors, this is great. In terms of brand and proprietary technology, I think that they have proprietary technology. Undeniably, it's an intangible asset. They have lots of information that they process, and they invest so much in data centers and analyzing data and all that they, as I said, that they can would be able to sell that services out, but they are not doing that. One thing here that I want to mention is in The Economist in 2016, in an article, The New Face of Facebook. They talk about Facebook in such an exalted position that only Google can sort of like compete with it. Then what I want to show you here, Facebook brand ranks below that of other technology companies. We know that Facebook name is not really quite loved by everybody. And so brand, cross it, because I don't think they have a really brand, but they do have proprietary technology. They take the mark in intangible assets. Network of people and data results in switching costs. So because whenever you have pictures, friends, a whole community within Facebook or within WhatsApp or whatever, you don't want to change. you're going to stick with those applications, and it's going to be harder for you to jump to another one. This switching cost is not one of the main advantages I see, even though it's good to have. And then the capital to build infrastructure, it's a barrier to entry because, as I showed you earlier, and I'm going to refresh here, they are going to spend 21 billion in capital expenditures next year. This is quite a high barrier to entry. Not only that, but if you see here, that is growing from 15 billion last year, and it grew from 4 billion in 2016. So you have to keep up with this pace, of investment if you want to compete with Facebook. And also, the level of expenditures overall is quite high. So I think that they have what's called barriers to entry due to the high level of capital. So now I'm going to discuss a little bit in more detail network effect, which for me is the most important of the competitive advantages. And okay, here we have users, and then the more users you have, the more users you attract. And so this creates a virtuous circle where they feed into themselves. More users on one side attracts more users, and this makes this like a snowball. This is good. So far is good. But then you have another loop, which is the more users you have, the more you attract advertisers. And this is where the revenue is coming from. So of course this is important. But in terms of network effect, I think it's not exactly beneficial, because what happens is that these advertisers not necessarily increase the number of users. I mean, users do not want to have distracted advertising while they go through their experience in Instagram or Facebook. So the more advertisers, for sure, it doesn't increase users and probably even reduces the number of users. I think that some users can find it beneficial to have some advertisements directed to their interests, and sometimes they are useful, but most of the time they are not, and they are obstructive, So and then you have the other one, which is the more users you have, and of course also the more advertisers you have, the more revenue you have. And the more revenue you have, or the more cash flow you have, the better services you can produce, not only because you have the financial capability, but also because you have the ability to trial and error all the services that you think could work. So you have like a laboratory where you can work with all these users and provide a better service. But here's where I have my question is, do you provide a better service with the goal of making a better experience to your user? Or are you thinking of a better service with the goal of attracting the more number of advertisers? This is where I think the conflict in Facebook is. I mean, this, even though has been growing like hell and it's producing cash flow like hell and it's quite healthy financially, to me, it has this conflict. Which road Mark Zuckerberg will choose? This one or this one? And this is something I want to share with you, this clip.
The practical question for also a service provider like Facebook is, what is the goal? I mean, are we trying to connect people so ultimately they will leave the screens and go and play football or pick up garbage? Or are we trying to keep them as long as possible on the screens? And there is a conflict of interest there.
Yeah.
I mean, you could have, one model would be, we want people to stay as little as possible online. We just need them to stay there the shortest time necessary to form the connection, they will then go and do something in the outside world.
Yeah.
And that's one of the key questions, I think, about what the internet is doing to people, whether it's connecting them or fragmenting society.
Yeah, in the near term, maybe showing some people some more viral videos might increase time, right? But over the long term, it doesn't. It's not actually aligned with our business interest or the long-term social interest. So in strategy terms, that would be a stupid thing to do. And now, I think a lot of people think that businesses are just very short-term oriented and that we only care about, people think that businesses only care about the next quarter profit. But I think that most businesses that get run well, that's just not the case. And I think last year on one of our earnings calls, I told investors that we'd actually reduce the amount of video watching that quarter by 50 million hours a day because we wanted to take down the amount of viral videos that people were seeing because we thought that that was displacing more meaningful interactions that people were having with other people, which in the near term might have a short-term impact on the business for that quarter, but over the long term would be more positive, both for how people feel about the products and for the business. And
as you've just seen the clip, there is a conflict here. So this is what Mark Zuckerberg has to say. I expect the digital town squares, like Facebook, and Instagram, to continue to grow in importance, but over time, I believe there's an even bigger opportunity with the digital living room. Facebook and Instagram, like being a town square where you have connection with lots of people. And then Messenger and WhatsApp, like sort of like a digital living room where you only connect with a few individuals. But for them, this over time is going to be a bigger opportunity. And they're going to build this focused on privacy. So when I see this, I ask myself, if you're going to build this based on privacy, how are you going to use this to advertise? And probably they can use it some other way. They can monetize it, I think. Whatever, I don't know. It's something they have to work. But the reality is that they don't know exactly how this is going to play out. And also some other people have asked whether more use of private social platforms will replace the more public platforms. Our privacy roadmap applies to all our products, but we believe there needs to continue to be both the digital town square and the digital living room. So in essence, even though there's a big opportunity in the digital living room, of course, the digital town squares are going to be big. So if we go back to my network effect graph, my view is that this is the route that Mark Zuckerberg is going to choose. Because by choosing this route, he will feed this loop, he will attract this, and this one is not as disruptive as if he were to forget about this and go straight here. I think being a smart guy, I think he's going to choose this, and you know, it would be beautiful if we can have a loop that closes in all ends. But at least I think it's a quite a big network effect to have half of the population of the world using it. It must be beneficial for them. Nobody is using something that is not causing any benefit. In terms of cultural or structural competitive advantages, which are a much more durable advantage in my view, I really can't find any. I don't see a culture where you see a competitive advantage in the culture itself. I think that Mark Zuckerberg has views and changes this and that, but it's not like they obsess about the customer that has Jeff Bezos, for example, and the whole Amazon culture. Okay, so now let's go to the last part of this quality side, which is financial position. Financial position is very easy for Facebook. It's a great financial position. They have no debt, no net debt. They have very little debt, but lots of excess cash. The net debt to EBITDA is not only less than 3, but it's negative. So this, no further discussion here, is a great financial position. There's no way that they will go bankrupt because of not meeting any financial covenant. So this is a great position. Okay, so now having discussed all these 4 points, I think that all of them are ticked in my view. So we will go and analyze the quantitative issues, projections, and intrinsic value, and see if the company is at the right price to buy it. Okay, the first thing I do is try to see what's going to be the market the overall market, overall advertising market, global advertising market, where that's going to be the revenues that Facebook will have to fight with other competitors like Google and Amazon. Not only within the digital world, but also with other means of communication, like newspapers or television, radio. So this is the overall everything. This is the past, and this is a projection that Statista is using, and I'm going to use this as the basis. Of course, when you project revenues of a company based on past performance and you say, okay, this is going to be the future, I want to make sure that I have a constraint here, and the constraint is this number here. This is the evolution so far of the advertising market. You see here that television was the dominant advertising platform up to 2014, and it started to decline. Here you have newspapers. They went to the same sort of like peak in 2006. But you see here, this is the largest, which is search, and dominated by Google. This one is social, dominated by Facebook. This black one is video, dominated by YouTube. And then there's others like e-commerce, which is this one, this green line here that keeps going up. And this is dominated, I think, probably by Amazon, even though it's more than $50 billion, and Amazon services is selling 25. So probably half of this is Amazon. So okay, so here you see the evolution. So together with this projection, which is the global, and this, which is mainly digital and ad spending, which is the realm of Facebook. Of course, Facebook has to compete in the digital and ad spending world. You see here that it has been growing in market share. Even in a few years, it has gone from 45% of all advertising to 60% of all advertising. So this is another thing I'm going to keep in mind when I project. I want to make sure that this percentage keeps going up, because I think it's going to keep growing. These are a few things to keep in mind when I'm going to make the projections. In The Economist, we have also the same article I showed you a little longer ago, a nice history of the company. And you see the white thing here is how they are growing in users. These are monthly users. We see here the IPO in 2012, and they buy Instagram. This was a great year for them. They bought Instagram for $1 billion. That was a sort of like a bargain, even though at that point, but at that time it wasn't that clear, you know. So I think that Mark Zuckerberg here has a lot of merit. WhatsApp, they paid a little bit more, but I think you can say 6-7 years later that it was a good acquisition price as well. And they started this artificial intelligence lab in 2015. Mark Zuckerberg is determined to bring the internet, and so Facebook, to people who are not yet linked. So we have two constraints here. One is the market itself, the advertising market itself, the global advertising market. Second, we have the digital advertising market as another constraint. And third, we have the number of people that can have access to internet first, and second, that can have enough acquisition power, enough purchasing power to buy the products that advertisers want to sell them. So we have all those constraints, and one of them is the number of people that can access internet. So they have some audacious plans of trying to bring internet to every single person in the world. Someone cooler comes along. Now Facebook will not be able to buy it like they did with WhatsApp and what they did with Instagram. Now they are not going to be allowed to do that. They already have too many eyes, regulatory from all over the world, trying to stop them. So they for sure they will not allow them to buy a potential competitor. So now probably in the future can come another WhatsApp or another Instagram or another Snapchat or even a TikTok that can start eroding the competitive advantages that they have. So that's a risk. They said Facebook does not make money from WhatsApp or Messenger, and is likely to introduce advertising on them. It's unlikely to introduce advertising on them. And I think in 2021, this statement hasn't changed. But it could charge businesses for finding customers. Guys, I think this is what they're going to do. WhatsApp and Messenger, what's called the digital living rooms, are going to be a source of income for sure. But in 2016, in this Economist article, they were saying that it was going probably to be a $10 billion for WhatsApp and Messenger in 2020. And the other constraint I was talking about is the population. No? But here you can see from the Worldometer, in 2020, the population of the world is 7.8 billion, and China is 1.4. The difference, 6.2 billion, is the population that Facebook can work with, because they are not allowed in China. The 3.3 billion users, monthly users, is 52% of that potential population. But if we go to 2030, which is the end of my projections, China will grow very slowly, but the world will keep growing quite fast. In fact, if you see here, number one position is going to be taken by India. And India is a heavy user of WhatsApp. In 2030, the world population is going to be 8.5 billion, less 1.4 of China. It's going to be 7 billion. So when I project the users of Facebook, I have to keep in mind that number. And what I've done, I'm going to show you in a minute, but it's going to be from 52% of the whole population today is going to be 63% of the population. So 63% of the population in 2030 is going to be using some family of the products. So if you see, this is the past, actual figures, and this is the future, my projections. Monthly use or daily users in this case is what Facebook has been publishing in their reports. But this couple of years ago, they started using daily active people and monthly active people, as I said, because it includes Instagram and WhatsApp. And you see here how, of course, this is higher than the users because you have more applications, and this is monthly, and this is the blue line is daily. And this is the relationship between daily for people and daily for users. As you can see, daily people is growing faster than daily users, and this is because these two are growing faster than Facebook. When I project, of course, I'm not going to keep this line like that because it's not possible, and I'm not going to keep it flat either because these two will keep growing faster. So I have made this projection, and if you see in my projection, the monthly active people by 2030 is going to be 4.5 billion people, and that's 65% of the world population ex-China, from the 52% in 2020. So I think this is something doable. I don't know, 10 years in the future, who knows, but at least it looks realistic. So this is what I'm going to use for my revenue projections. Then I have to make a projection of how much I think they are going to extract from each user in terms of advertising. No? A Bloomberg opinion article here, they are talking about Twitter. What I take from this is that the dynamics of the ad business is going to be dominated by Facebook and Google in the future. And in this same article, they mentioned that the New York Times in 2006 was charging $534 per year in subscription and was taking $1,000 per subscriber from ads. So keep this number in mind. If we go to the advertising global market with all this I have shown, this is my projections. This is the past, this has already occurred, and so I am going to project. And what I'm going to do is the growth in advertising global is this line here, orange, which has been roughly on average is 4%. And what I'm going to do, this is going to be roughly 8% in my projections. So here we can see that in my projections. 4% is what has been the growth of global advertising. And I'm going to project it at these levels. 12%, 6, 5, 5, 5, 7, and then going to 5. This is my projections. This is what I show here. 5% roughly is this, and 12% here. But the digital and the mobile growth, which has been much faster in the past, I also think is going to be faster, but not dramatically so. Because my constraint here is that if you see the market share of digital and mobile, of the market share within the global advertising, this clear blue line, is on this axis, and it was on the 20s, and now it's going up today 66%. And if you see from here, this is my projection, it's going to be 85%, roughly 87%. This is 87%. So of course I cannot make this grow dramatically higher like it has happened in the past, because then it would mean that the whole global advertising market is going to be digital and mobile, and of course that's not possible. So in this graph now I want to include Facebook and see what portion, how it plays within the global market. So when I add Facebook, which is this green line, the sales, this is the way I have projected, this is the actual sales up to here, and this is my projections. And they will be 200 billion and a bit by 2030 in my projections. And this is the market share of Facebook in the global market. So you have the global advertising, which is this dark blue, and you have the digital, this gray line. You see that this gray line is growing faster. And one important thing is the digital market share is going to grow from 66% roughly to 87% of all advertising, global advertising, which I think it's quite a lot, but this is probably possible. And Facebook within this gray, which is all, is going to stay roughly the same share, 22% of the market. It has been growing, of course, within this market up to 20% or roughly, a bit more. And I think it's going to go to 22. This is my projection. It has very powerful players to compete with, Google and Amazon. Anything that, if I want this line to go higher in terms of percentage of market share, it means that they will have to gain percentage from Google and from Amazon. I'm making projections of Amazon and Google, and of course I cannot individually make this grow without being consistent with what I'm projecting for Google. So this is why I am projecting these two with Facebook. In my projections here, Facebook ad only market share was this, and this is going to be the market share in the future from my projections, up to 25%. And this is one thing I want to show you as well, which is Facebook ad versus total sales was 100% up to 2017, and then 99%, 99, 98. And I'm going to consider that they go slowly towards 0.89% or 90% of all sales. So what I'm showing here is only advertising sales. And here you can see in this graph what I just showed you in the model, which is the revenues that we know, the actual revenues of Facebook, 42% year to year. And this is my projection, is going to be 11.8% year over year growth. The proportion of sales which represent ad revenue is this one, 100%. Then it went down to 98%, and then I'm projecting it to go down slowly up to 89%. So one potential revenue growth avenue for Facebook could be to increase this amount of revenue, which is from non-ad businesses. That could be a possibility, I don't know, but I'm not projecting too much into that. So let's move now to the other portion of the equation, which is what's going to be the average revenue per user that I'm going to project. Here I'm showing you what has happened. And if you see, US and Canada have been growing steadily at 32% per year, which is quite dramatic. But if you see, most of the countries have been growing quite fast in terms of average revenue per user. US and Canada is by far the largest. This one is 5 times roughly the average, and it was here, look, only 2 times the average. So it's growing much faster than the rest. So this is a little bit of to show you that if the New York Times could extract $1,000 per subscriber from ads. Facebook in the US is taking $154 per user. So, well, of course, I don't think that they could reach 1,000. The demographics are completely different, but to have an idea. So this is average revenue per user, and this is my projections that I just showed, and average revenue per person. If you see from $30, which is this average, $31, $32, $32, that number there. This is my projections. It's going to go up to 70 something. But the annual average revenue per person, which is much smaller because it includes Instagram and WhatsApp, which are not yet fully monetized, and it has a broad, much more users. So of course the denominator is bigger, so the average per person is smaller. This is the level that they had in 2020, and this is my projections based on all what I just showed you. This is the way that they will grow in my assumptions. So these numbers here are 9%, and this is more on a 7-8%. Okay, so this is I showed you already. My projection is that by 2024 it's going to be 145 billion of revenue, which you see here, 140, this number here. But there's some analysts, and I've seen a couple, that project roughly 170 something. So quite a substantially higher level. Because I think one of the constraints, as I said, is the number of people that can use Facebook or Instagram or whatever, and the market, the digital market. So they cannot grow to the moon, neither of those. So with those constraints, and also with the constraint that you have a Google player there, Amazon, some others that are going to compete, that you cannot just make these revenues grow in the same way that they have been growing. There would be some constraints, and this is what I'm doing here. But apparently some analysts are projecting this. I don't know what are the basis, but for me it's really optimistic. And not only optimistic, but it doesn't sort of like, if they keep growing this way up to 2024, then they are going to eat the whole market. They are going to eat Google. They are going to eat even they will eat the whatever is non-digital as an advertising platform. So I don't know what, unless they are assuming that a new business is going to thrive within Facebook, and they are projecting that. I don't know. But if we go to my financial model, all the income statement, balance sheet figures, and some other metrics, cash flow that I use, and I am going to project them into the future for 10 years. And I have discussed so far why this is the revenues that I have projected. And overall is the 11% that I showed you in one of the slides. So with that revenue, then I want to make sure that the operating margin or the operating profit stays at a reasonable level also. So what I measure here is that the margin, which has been quite healthy, will still be healthy, but will grow slowly, because volume, it will leverage, let's say, the business. So this is a level I like, from 30 to 40. And the same thing with the EBITDA. I try to make sure that the margin stays at levels similar to what they have been in the past, growing slightly, but not dramatically. The expenses, in my assumptions, is 70 billion and 107 in revenue. And if you remember, in the call or in the annual report, they were expecting capital expenditures of 21 billion, 23, and expenses in 68 to 73 billion. So this is what I am assuming, 70, which is midway. Then the balance sheet, I will assume that they have a net debt of 0.9 negative, which is similar to what they had last year. And that means they will have excess cash, more than that. With the EBITDA that I am projecting, and with this enterprise value to EBITDA factor, which I'm using 20, which is roughly what they have in 2020, that gives me a price. Then I go to the cash flow statement, and I project the cash flow, operating cash flow, at a certain growth. I also project the capital expenditures, so that the first year I have what they are saying here in the call, 21 to 23 billion. And this is 21% of revenue. And then I'm going to keep it quite high at 20% of revenue, which is, if you see, levels quite high compared to the past. On average, it has been 18%, but I'm going to increase that to 20. And that gives me the level of free cash flow that I'm projecting. So with the free cash flow and this factor 22, which is much smaller than the factor enterprise value to free cash flow that they have experienced in the past. This is what's going to drive the target price 10 years from now, because I'm still going to use 22. So with this free cash flow and the 22, I get the price, and also with the diluted stocks, this is going to be the price. On free cash flow basis, this is going to be the price. So using free cash flow times 22 divided by the number of shares. And then based on EBITDA, this is going to be the price, which is EBITDA times 20 divided by the number of shares. And this is going to be the average of the two. So this is going to be my target price, 707 in 10 years time. So if this is the target in 10 years time, I'm going to have my calculation here. I'm going to have 10 years price target 707, current price 294. Well, this is March, end of March, 22 of March, but probably today is different, but it's very similar. That's 9.7 years of projections. The yield is going to be 2.9, and this is not the dividend yield, but this is the adjusted free cash flows per share yield, which I calculate as my free cash flow projections plus whatever they receive in share issuances in this case. This is going to be the yield, 3.5%. And this 3.5% is based on a price that I am assuming here of 245, which is not the case. The case, you have to use the real yield, which is based on this price, the price that you're paying. So it's going to be 2.9. So what I do is a calculation, and this is going to be some sensitivities to price. So if I pay the 294, I'm going to get a 12% return, which is a quite healthy return, I think, especially considering that I have been quite conservative, I think, especially compared to analysts of in my projections of Facebook. So I'm really happy with 12% and the risks I see with Facebook. If I pay 110, I will be in the 10% level, probably even 115 I can pay and be over 10%. So anything over 10% for me is quite reasonable. And so that means that this 338 or 340, let's say, 116 here, and we'll get to 340. This is the beauty of financial models. You can change whatever you like and then make it look the way you want it to look. They are so dangerous sometimes. So, but this would be for me around 340 the fair value. If you pay 300 for Facebook, it's, I think, a good proposition today. That's my evaluation of Facebook. I don't know, long video probably. So I hope you like it. If you like it, please give it a like to the video. And well, in the next couple of weeks, I'm going to upload more valuations or analysis from companies, and also I'm going to upload some other interesting issues about finance that I could probably make shorter videos. Thanks very much for watching, and bye-bye.